All right, let's head over to the New York Stock Exchange and check in with our very own Jared Blikre on the markets. Jared, today, more sellers than buyers.
I'm not going to get over your prowess when it comes to some of this technical analysis here, which I say tongue-in-cheek because guess what? That's exactly how auction markets work. So let's go to the Wi-Fi Interactive where we see the NASDAQ giving back a little of the recent gains. But guys, we are coming off a 6-day thrust in the markets that has been absolutely incredible. So not surprised to see markets consolidating a little bit after you can see NASDAQ still holding on to almost 4% over the last 5 days, and even more impressive when you go over the last 7. So let's take a look inside the market. I'm seeing the US dollar a little bit higher, Treasury market kind of quiet. Nice to see not any big movements in the bond market that's disrupting things. But today, energy is in the forefront. Tends to be in either the pole position or the biggest lagger. Today, it is in the leadership spot. It's up 2%. Staples, consumer staples also up marginally. Utilities just flashing a little green there. But tech giving back the most gains. That's down about 1.5%, followed by consumer discretionary and healthcare. Now, let's take a look inside the market, inside the NASDAQ 100, where we see Tesla up another 0.6%, just crossing over the 1 trillion threshold only yesterday, yet again. Hadn't done that since the beginning or middle of January, I would say, of this year. Microsoft down 1.5%, Amazon down a little bit. NVIDIA, interesting, NVIDIA had a big investor day yesterday, lots of excitement over some of their new products, but they're going to have to spend a lot more money to be able to compete and grow in the AI market. So I think artificial intelligence probably going to be a little bit costly, and so investors taking a little bit of money off the table. I think that company has to commit more resources towards that end. You can see down about 4% over the last 2 days. Also want to take a quick look at the travel sector here. Let's see if we can pull this up. My connection's a little bit slow, but it looks like we do see some red on the screen here. Trip.com, a Chinese stock, that's down 4%, and some marginal losses for the airlines like Delta, down about 1.5%.
You know, Jared, folks, of course, as always, are examining valuations here when they try and decide whether to come back into the market. And Saz flagged a chart of the CAPE ratio this morning, which for some folks is a favorite way to measure those valuations. Not sure it's one of your favorites, but talk us through it.
I'm not even sure how to address this. Can I just ask Brian? Can I kick this over to Brian? What do you see in this chart? Now, I don't have it in front of me, but I know what it looks like. We've seen a lot of peaks, a lot of valleys. Brian's writing about squiggly lines today. I love squiggly lines because that's what technical analysis is all about. But what do you see in this, and what actionable information is in it for you?
Jared, don't even get me going here. What I see here, I can say it in a couple words: stock market overvalued.
Yeah. Okay, so let me address that because Sam Rowe was writing about this in January. Goldman Sachs did an analysis of the CAPE ratio and determined that it was basically not that useful. Biggest reason why is because valuations are not mean reverting. Are we in a new normal? Jeremy Grantham thinks so. So I'm not going to put it to the fundamental. I'm not going to give my opinion on the matter. I'll kick it to the fundamental experts. But if Goldman Sachs and Sam Rowe don't think the CAPE ratio is necessarily that good for timing, and especially because it's on a 10-year leg, it takes a long time to get those moving average crossover signals as well. I'll admit that. It depends on your time frame. So if you're a long-term investor, if you're gleaning something from this, it gives you the confidence to stay in the market during troubled times, that's great. If it tells you to get out, well, just think, you're probably going to miss out on a lot of those gains. I prefer technical analysis where all that matters is what's on